How it started, 2. DECADES before the crash. Most people's mental starting point for this story is September 2008. The actual starting point is closer to a decade earlier. Through the 1990s and early 2000s, a series of deregulatory moves reshaped American finance. In 1999, Congress passed the Gramm-Leach-Bliley Act, repealing key parts of the Depression-era Glass-Steagall Act that had separated commercial banking from investment banking. In 2000, the Commodity Futures Modernization Act exempted most over-the-counter derivatives, including the credit default swaps that would later play a central role in the crisis, from federal regulation. Around the same time, historically low interest rates, aggressive mortgage lending, and Wall Street's near-inexhaustible appetite for mortgage-backed securities combined to fuel a housing bubble. Home prices rose dramatically through the mid-2000s, driven by increasingly loose lending standards, including subprime mortgages issued to borrowers with weak credit. Wall Street firms packaged these mortgages, many of them low quality, into complex securities and derivatives, which credit rating agencies frequently rated as safe investments despite the underlying risk. By 2007, mortgage-backed securities issuance had nearly tripled from a decade earlier, and the majority of subprime originations came from non-bank lenders operating with minimal oversight, not from traditional regulated banks. Part 2. The Bubble Bursts, 2006-2008. Housing prices peaked around 2006 and began falling, eventually dropping roughly a third from their peak by 2011. As adjustable-rate subprime mortgages reset to higher payments homeowners couldn't afford, defaults and foreclosures spiked. The securities built on those mortgages lost value rapidly, and banks that held large amounts of them found themselves sitting on massive, uncertain losses. 2008 brought the crisis to a head in a series of escalating shocks. In September, the government placed mortgage giants Fannie Mae and Freddie Mac into conservatorship, pledging up to $200 billion to stabilize them. Then, over one catastrophic weekend, September 13-14, the Treasury and Federal Reserve chose to let the 158-year-old investment bank Lehman Brothers fail rather than rescue it, and it filed the largest bankruptcy in U.S. history on September 15, with $639 billion in assets, wiping out roughly 26,000 jobs. The very next day, September 16, the Federal Reserve reversed course and stepped in to rescue the insurance giant AIG with an $85 billion loan, fearing its collapse would take down banks worldwide that were counting on AIG-issued credit default swaps to cover their own losses. Financial markets went into a genuine panic. Money market funds saw massive withdrawals, short-term corporate lending rates spiked even for blue-chip companies, and confidence in the banking system evaporated almost overnight. Part 3. TARP. On September 19, Treasury Secretary Henry Paulson proposed a $700 billion fund, what would become the Troubled Asset Relief Program, or TARP, to buy up toxic mortgage-related assets from banks and restore confidence in the system. It was not a quiet, uncontested process. On September 29, the House of Representatives initially rejected the bailout bill, triggering a 777-point single-day plunge in the Dow Jones Industrial Average. At the time, the largest one-day point drop in its history, wiping out roughly $1.3 trillion in market value. Congress revised the bill and passed it days later. On October 3, 2008, President George W. Bush signed TARP into law, a $700 billion program authorizing the Treasury to inject capital directly into banks, rather than simply purchasing bad assets as originally pitched. 10 days later, Paulson summoned the CEOs of the largest U.S. banks to a Treasury Department meeting and effectively required 9 of them to accept a combined $250 billion in capital injections. Whether they wanted the money or not, partly to avoid stigmatizing the banks that genuinely needed it. Part 4. Where the money went. TARP funds ultimately flowed to more than 700 institutions, and the program's scope expanded well beyond banks. When President Barack Obama took office in January 2009, his administration used remaining TARP authority to extend loans to the struggling auto industry. General Motors and Chrysler both filed for bankruptcy that year and were restructured with federal government support. AIG alone eventually received roughly $182 billion in total government support. This is a detail that gets flattened in most retellings. The bailout wasn't a single event under a single president. Bush signed it and administered its first phase. Obama inherited it, continued it, and significantly expanded its use into the auto industry. Part 5. How it ended repayment and reform. By the numbers, most of TARP's money did come back. Treasury ultimately dispersed roughly $443.5 billion and collected back about $425.5 billion, for a net program cost of roughly $31.1 billion, far below the headline $700 billion figure most people remember. AIG's rescue alone eventually generated a reported $22.7 billion profit for taxpayers after full repayment, and Fannie Mae and Freddie Mac repaid more than $187 billion. Goldman Sachs, Morgan Stanley, and American Express fully repaid their TARP funds with interest and repurchased associated government warrants at a profit to taxpayers. Citigroup was the notable exception. It received the largest single-institution bailout of the crisis, and rather than repaying in cash, the government ultimately sold its stake in Citigroup to private investors. In 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, the major regulatory response to the crisis, introducing stricter bank capital requirements, new oversight of large, systemically important institutions, and the creation of the Consumer Financial Protection Bureau. Part 6. The story didn't stop there. In May 2018, President Trump signed the first major rollback of Dodd-Frank, raising the asset threshold for banks automatically subject to strict Federal Reserve oversight from $50 billion to $250 billion, freeing dozens of regional and mid-sized banks from stress testing and enhanced scrutiny. In March 2023, Silicon Valley Bank, which had grown to roughly $209 billion in assets, just under that new $250 billion threshold, collapsed in one of the largest bank failures since 2008. Multiple financial analysts and lawmakers directly linked the failure to the reduced oversight the 2018 rollback had enabled, noting SVB's own CEO had lobbied for the exact threshold change that kept his bank out of stricter supervision. And the deregulatory trend hasn't stopped. In March 2026, President Trump signed a further executive order directing federal regulators to reconsider core post-Dodd-Frank mortgage rules, aimed at reducing compliance burdens for community and regional banks, continuing a rollback process that's now been unfolding for the better part of a decade. Part 7. What historians actually get wrong. Myth 1. This was Obama's bailout. The single most common misremembering. TARP was designed by Bush's Treasury Secretary and signed into law by Bush himself in October 2008, before Obama had even won the election. Obama's administration extended and expanded the program, notably into the auto bailout, but he inherited, rather than created, the bank bailout itself. Myth 2. Taxpayers made a profit. The bailout basically cost nothing. This is technically true on a narrow, nominal basis. Cumulative TARP collections did modestly exceed disbursements. But economists who study the program closely argue this framing is incomplete. It doesn't account for the fact that the return taxpayers received was far below what a private investor would have demanded for equivalent risk. doesn't count the broader economic costs of the moral hazard created by too-big-to-fail guarantees, and glosses over the fact that Citigroup, the single largest recipient, never fully repaid in cash. TARP made money is a defensible narrow claim and a misleading broad one. Myth 3. Repealing Glass-Steagall caused the crisis. This is a genuinely contested claim among economists, not a settled fact, and a good, what historians get wrong, video should say so honestly rather than pick the more dramatic answer. Some analysts, including at Better Markets, argue Glass-Steagall's repeal enabled the too-big-to-fail interconnectedness that made the crisis so severe, pointing to Citigroup as a direct product of that repeal. Others, including at the Cato Institute, note that the firms at the epicenter of the crisis, Lehman Brothers, Bear Stearns, AIG, were either pure investment banks or insurers never covered by Glass-Steagall's separation rule in the first place, meaning its repeal couldn't have been the direct mechanical cause of their failure. The honest version, deregulation broadly mattered, but pinning it specifically on one 1999 law oversimplifies a more tangled set of causes, including derivatives deregulation, lending standards, and credit trading failures. Myth 4. Dodd-Frank fixed the system, and that's the end of the story. It isn't. Dodd-Frank was rolled back significantly in 2018, a rollback that multiple analysts tied directly to the 2023 Silicon Valley Bank collapse, and as of March 2026, the federal government is actively pursuing further reductions to post-crisis mortgage and bank oversight rules. The regulatory pendulum from this crisis has been swinging back and forth for over 15 years. It hasn't settled, and treating 2010 as the story's ending misses everything since.